During tax season, a lot of people are focused on the potential tax deductions from contributing to an IRA or other tax-deferred account. While a common starting point, the tax advantage potential of IRAs isn't just limited to tax-deferred contributions and tax deductions. So, should you consider a Roth IRA? And in this training, we're going to cover several reasons why it might be a good time to consider opening and funding a Roth IRA before the April 15th tax deadline, of course assuming that you qualify. So why April 15th? Because if you haven't reached the annual contribution limit for last year, it may still be possible to contribute to a new or existing IRA for the last tax year before the tax filing deadline this year. Unlike a traditional IRA, contributions to a Roth IRA are made after tax and do not provide a tax deduction. However, investments within a Roth IRA grow tax-free, and funds distributed after the age of 59.5 are also tax-free as long as the account has been established for at least 5 years and all IRS rules are followed. So this is the seed and the crop analogy. You either pay taxes on the seed or you pay taxes on the crop. And many investors see the opportunity in a Roth IRA of getting the taxes out of the way on the seed so they don't have to pay it on the proverbial crop. With a self-directed Roth IRA at Equity Trust, you have the freedom to invest tax-free in both traditional assets and alternative assets such as real estate, notes, private debt, private equity, digital currency, precious metals, and much, much more. So let's jump right into the training. All right, so let's go through the 3 reasons to consider opening and contributing to a Roth IRA this tax season. Number 1, make up for lost time and boost your tax-free retirement savings. If you feel that you're a little bit late to the game, or if you're someone that's very young, you're going to learn that it's very, very important that annual contributions are made to the IRA, because every year that goes by that you don't make a contribution, that's less money that you have in the IRA that you can leverage to grow tax-free going forward. If you thought about opening a Roth IRA but didn't last year, don't worry, you may still be able to establish your account and contribute before the April 15th deadline. Making last year's contribution to a Roth IRA provides an opportunity to make up for lost time and increase your tax-free retirement savings without reducing the amount you contribute this year. So in other words, you could potentially make a contribution for last year and this year all in one fell swoop. From a tax reporting perspective, it will be as if you started the account last year. This allows you to catch up on missed savings opportunities from last year and maximize your Roth contributions this year as well, assuming, of course, that you're eligible to make those contributions. Number 2, if you don't qualify for a tax deduction on your traditional IRA contributions, it may be time to consider a Roth IRA. You may have been told this before. Hey, it doesn't make sense to contribute to my traditional IRA because maybe you work for a company and you have a 401k or a 403b and you're a high income earner. So what you're being told is that you don't get a deduction for your traditional IRA contributions. That's okay. We're going to talk about here in just a moment on how you could potentially get the money into a Roth IRA. So did you know the IRS limits you in how you can receive tax deductions in contributing to a traditional IRA? Okay, so that's directly from the IRS. Retirement savers who exceed what we call the MAGI limits, that's what this is called, MAGI limits, and don't qualify for a full or partial deduction on their traditional IRA contributions might want to consider just simply contributing directly to a Roth IRA. Or for some folks, you might need to contribute to a traditional and then convert over to a Roth, which is known as the backdoor Roth IRA. And we have other training programs that drill down further into that concept. If the benefit of a tax deduction on traditional IRA contributions is reduced or no longer available, ask your CPA, your accountant, or your advisor if it makes sense to just simply contribute to a Roth IRA or potentially use a backdoor Roth IRA approach. For those covered by a retirement plan at work, the MAGI limits for Roth IRA eligibility are significantly higher than MAGI limits that phase out the ability to deduct traditional IRA contributions. So for example, single filers are not eligible for a tax deduction on traditional IRA contributions in 2020 if their modified adjusted gross income is $75,000 or greater. So think you're a single individual, you're contributing money to a 401k with your job, and let's say you're making $80,000. So you're over that $75,000 amount. The government tells you that if you contribute to a traditional IRA, it's okay to do that, but you're not going to get a tax deduction. So what you might consider is contributing directly to a Roth IRA, or if you make too much money and you don't qualify for a direct contribution to a Roth IRA, you can use what I referred to before as the backdoor Roth contribution, which is contribute to a traditional, immediately convert over to a Roth. Your net effect is after-tax dollars in the Roth IRA. Now, you can review these MAGI limits on the IRS website for more information and as it pertains to your specific situation. All right, number 3, start your Roth IRA 5-year seasoning. All right, this is what's known as the 5-year seasoning period. Establishing a Roth IRA and making last year's contributions before the deadline will start the clock ticking January 1 of the previous year. That's right. So let me give you an example. It's, let's say, February 20th, and I set up my Roth IRA for the very first time, and I make my very first contribution. That account, as going to be considered for the 5-year seasoning purposes, opened January 1 of the previous year, providing that I'm eligible. So going back to making up for lost time, you have the opportunity to make up for lost time, but there is some urgency to get it done within this window between January and, of course, April 15th. So here's why the 5-year seasoning period is so important, all right? Distributions from a Roth IRA, of course, are tax-free, providing that you meet the requirements. And there are 2 key requirements that you need to understand. Requirement number 1, to take a tax and penalty-free withdrawal from a Roth IRA. So you grow this account over many years. You could be investing in real estate, you could be investing in stocks, bonds, mutual funds, you could be investing in private equity, metals, cryptocurrencies. There's a wide array of different types of investments you can invest in. You grow this account over many years, and then at 59 and a half or older, the government says that you can start taking money out of that Roth IRA 100% tax-free. The contributions, the growth, the earnings, etc., tax-free. That's the benefit of a Roth IRA. But see, there's this 5-year seasoning period with a Roth IRA. And the 5-year seasoning period says that you have to have a Roth IRA established and funded for 5 years and 59 and a half before you can start taking tax and penalty-free withdrawals. This is very, very critical to understand. So consider this. Let's say there's an individual that's 60 years of age. They open up a Roth IRA for the first time in their life, and they make a contribution. They can't start taking tax and penalty-free withdrawals from that Roth IRA until they're 65 because of this 5-year seasoning period. And this is where leveraging this April 15th deadline comes into play. If you're someone that's over the age of 55, have never had a Roth IRA with any financial institution before, and you like the idea of tax-free compounding interest, then what you might want to consider is setting up and funding a Roth IRA. And when you set up and fund that Roth IRA, so as long as you're eligible, that Roth IRA essentially is backdated to January 1 of the previous year, giving you an extra 12, 13, potentially 14 months, depending on when you set up the account, of seasoning period. So instead of having to wait 6 years, you may only have to wait 5 years to start accessing that money tax and penalty free. That's what the 5-year seasoning period is all about and why it's so important. Okay, one last final note. It might be a good time to consider a Roth IRA if you've dropped to a lower tax bracket, or if you currently fall under the MAGI limits to be eligible to contribute to a Roth IRA. You may consider starting a Roth IRA while you still qualify. So for example, let's say you're a little bit younger and could be someone that's in their mid-20s, their 30s, they have an aspiring career ahead of them, and they feel that they're going to be a high income earner in the future. That type of individual might consider setting up and funding a Roth IRA now while they can still make direct contributions to the Roth IRA. Now keep in mind, I mentioned earlier, if you've been told that you make too much money and you don't qualify for a direct contribution to a Roth IRA, there is the possibility of doing a backdoor Roth contribution, where you simply contribute to a traditional first and then immediately convert over to a Roth IRA. Your net effect is after tax dollars. You're not double taxed, it's after tax dollars in your Roth IRA. So a lot of opportunities for just about anyone in the United States to take advantage of a Roth IRA, and I encourage folks to take a further consideration into, does it make sense for you or not. We look forward to seeing you on the next training program.